Debt is often seen as a double-edged sword in the financial world. It can be the key to creating huge fortunes or a direct path to bankruptcy. The question is not just whether to use debt, but how to use it strategically to build and expand financial empires. In this text, we will explore how wealthy and successful individuals use debt to leverage their fortunes and transform opportunities into substantial wealth. Debt, when managed well, can be a powerful force capable of propelling your dreams and endeavors to new heights. The rich build empires. The strategic use of debt to build financial empires is a practice that dates back to the 19th century, exemplified by the trajectory of John D. Rockefeller, one of the richest men in history. Rockefeller was born into a humble family, the son of a farmer, and had no formal education in finance. Despite this, he demonstrated exceptional vision and an ability to seize opportunities when he began his business career. His starting point was a modest $1,000 loan provided by his father. This initial capital, although small, was crucial to the beginning of his entrepreneurial journey. Rockefeller began his career in the agricultural commodities sector, and his initial investment quickly generated considerable returns. His ability to identify opportunities and adapt his strategies was evident from the beginning. When the oil industry began to gain prominence, Rockefeller saw an opportunity to transform the market from kerosene, traditionally produced from coal, to oil. This transition not only reduced production costs, but also offered superior efficiency. Rockefeller's innovation in using oil instead of coal and the construction of an internal system for producing barrels at a reduced cost were significant milestones in his career. These innovations helped to attract the trust of lenders, allowing you to obtain loans on favorable terms. Through strategic debt, Rockefeller was able to acquire smaller competitors, consolidating its position in the market. This move not only strengthened its monopoly in the oil industry, but also guaranteed substantial discounts on rail transportation, resulting in significant cost savings. These discounts allowed it to offer lower prices to consumers, further solidifying its dominant position in the market. By the 1870s, Rockefeller, at age 31, had become a millionaire, and his company, Standard Oil, refined 90% of the oil consumed in the United States. His meticulous approach to debt, which included timely repayment of loans and a willingness to borrow when expansion opportunities arose, was a key factor in the building and expansion of his empire. Rockefeller's story exemplifies how debt, when used strategically and thoughtfully, can be a powerful tool for achieving great financial achievements. The rich don't receive a salary. The popular perception that the rich sustain their lavish lifestyles exclusively through high salaries is a common misconception. Many of the world's richest individuals, like Elon Musk, use sophisticated financial strategies that go beyond simple salary compensation. Musk, for example, revealed in a tweet that his extravagant lifestyle is not funded by a traditional salary. Instead, he uses his shares in Tesla as a form of collateral to obtain loans, allowing him to maintain a luxurious lifestyle while avoiding the sale of his shares and the resulting capital gains taxation. This financing method offers two main benefits. First, borrowed money is not considered income, which means it is not subject to income taxes. Second, by avoiding stock sales, Musk avoids paying capital gains taxes, which can be substantial. Instead, he uses his shares as collateral to obtain loans, which are then used to finance his lifestyle and other investments. With an interest rate of approximately 6%, Musk needs to ensure that Tesla's stock value grows at least 6% to cover the cost of debt. If Tesla continues to rise in value, Musk can maintain his robust financial position and luxurious lifestyle without selling his shares. This cycle of borrowing and investing allows him to utilize capital efficiently, maximizing the growth potential of his wealth without incurring large taxes. This approach is a clear example of how the rich use financial strategies to optimize their resources and minimize their tax burden. By adopting smart financing and investing methods, high-income individuals can make the most of their financial opportunities and maintain a lifestyle that may seem unaffordable to most. The rich love real estate. Real estate is a preferred area of investment for the wealthy, who often use debt to acquire valuable properties. The approach of the rich towards investing in real estate is different from that of most ordinary people. Instead of paying for properties in cash, many of the rich use loans to acquire properties, often keeping their own capital invested in other assets. A notable example is Elon Musk, who in 2018 borrowed $61 million to purchase 5 homes in California, even when he had enough resources to pay in cash. This strategy illustrates how debt can be used effectively to maximize return on investments and protect capital. The strategy of the rich involves using debt to acquire income-generating assets, such as real estate. Suppose an investor finds a property worth $1 million and finances 80% of that amount with a loan. The investor's initial investment would be just 20%, while the loan covers the rest. If the property is rented for $140,000 per year, the investor could generate a profit of $20,000 after paying maintenance expenses and debt. Additionally, property depreciation offers a significant tax advantage. Depreciation is an accounting cost that allows investors to deduct a portion of the property's cost from their taxable income. In the example, the depreciation of $1 million property is calculated over 39 years, resulting in an annual deduction of about $25,641. This can create a tax loss of $5,641 even as the investor continues to increase their net income. In this way, debt and depreciation work together to maximize return on investment and minimize tax burden. Strategically using debt for real estate investments allows the wealthy to expand their asset portfolio and make the most of economic growth opportunities. This approach demonstrates how debt, when managed well, can be an effective tool for creating wealth and building a robust financial portfolio. The rich don't mix finances. When Elon Musk decided to acquire Twitter in 2022, he chose to finance the transaction with a significant loan of $13 billion, despite his enormous personal fortune estimated at around $250 billion. This decision may seem counterintuitive to many, especially considering that Musk could pay the full amount up front. However, this approach makes sense when we examine the concept of a leveraged acquisition. Buyout, LBO. In an LBO, the financing of the purchase is secured by the assets of the acquired company. In the case of the Twitter acquisition, the $13 billion loan was secured by the company's own assets and expected revenues. The logic behind this strategy is that if the acquired company becomes profitable, it will generate enough cash flow to cover debt payments over time. This cash flow comes from the company's operations and is used to repay the loan, allowing the buyer to conserve their own capital. If the acquired company does not perform as well as expected and is unable to generate the necessary cash flow, creditors can only recover their money by selling the company's assets. This structure limits the risk for the buyer and protects their personal assets. In Musk's case, by using an LBO to acquire Twitter, he ensured that his own resources, such as his Tesla shares and other personal assets, remained intact. If Twitter failed, or if the company's value did not meet expectations, creditors could recover the amount they borrowed only by selling Twitter's assets. This financing approach allows the wealthy and large investors to make significant acquisitions without compromising their personal assets. It also provides flexibility to explore new investment opportunities and expand your portfolios while limiting personal financial risk. The strategy of not mixing personal finances with corporate investments is an effective way to protect personal wealth and leverage growth opportunities. The rich generate liquidity. The wealthy often hold illiquid assets, such as property and business interests, and use debt to create liquidity and take advantage of investment opportunities. These assets, while valuable, are not easily converted into cash quickly. Therefore, the wealthy turn to financing strategies to ensure they have the capital needed to explore new opportunities without having to liquidate their existing holdings. A notable example of this strategy is Mukesh Ambani, chairman of Reliance Industries, which in April 2023 borrowed $5.5 billion to implement a nationwide 5G network in India. Although Ambani owns a vast array of assets, including a 27-story residence in Antalya and several properties around the world, he chose to use debt to finance the 5G project. This decision allowed him to preserve his liquid assets and keep them untouched, ensuring they continued to grow in value and contribute to his fortune. Investment in 5G represented a significant economic growth opportunity for India. The implementation of a 5G network would not only boost the country's economy, but also generate new revenue streams and business opportunities for Ambani and his company. Understanding the importance of this opportunity, Ambani preferred to borrow to finance the project rather than compromising his existing assets. This allowed him to maintain the integrity of his investment portfolio and continue to invest in other growth areas. Using debt to create liquidity is a key strategy for the wealthy, allowing them to take advantage of investment opportunities while keeping their valuable assets untouched. By taking this approach, they can grow their business, invest in new technologies, and continue to build their wealth without needing to sell major assets. The rich inflate. Their debt's inflation can be a powerful ally when it comes to managing debt, especially for those with high financial capacity. Many wealthy people use sophisticated strategies to inflate their debts and reduce the impact of payments over time. A notable example of this strategy is Mark Zuckerberg, who in 2012 obtained a mortgage loan with an exceptionally low interest rate of 1.05%, while the average market rate at the time was 2.76%. Obtaining a reduced interest rate is often possible due to the individual's high financial position, which reduces the risk to lenders. In Zuckerberg's case, his vast fortune and solid financial reputation contributed to the granting of a more favorable interest rate. The reduced rate allowed him to borrow at a lower cost, maximizing the financial benefits of the loan. Zuckerberg used the borrowed capital to purchase a home he wanted and continued to live in it, while investing his own money in opportunities that offered high returns. Additionally, he chose to spread the mortgage payments over 30 years. This approach not only reduced the real burden of payments due to inflation, but also allowed him to keep his capital available for future investments. Inflation reduces the real value of payments over time, making future payments less expensive in real terms. By adopting this strategy, Zuckerberg was able to make the most of available capital and direct it towards high-return investments, while managing his debt efficiently. This debt inflation strategy is a common tactic among the wealthy who understand the importance of maintaining financial flexibility and maximizing returns on their